Hello, Money Multipliers. Welcome back to another episode of the Money Multiplier podcast. I'm your host, Hannah Kessler, and we ask ourselves, do our dollars make sense? So, in today's episode, I know I get a lot of questions about this, and that's why I'm really titling it the MEC Deep Dive. So, a lot of folks, especially when it comes to us talking about becoming our own bankers, and actually look at my new merch here today. Shout out Jason Lowe from Canada. But when we're utilizing a whole life policy, especially to conduct our banking and financing needs through, the conversation of the MEC, or what's also called the Modified Endowment Contract, comes up a lot. And most of the times, really what you folks are doing, especially when you're working with us over here at the Money Multiplier, is you're contacting, whether it be your agent or your implementation specialist, and you may be coming to them saying, hey, Larry, I just sold something, or I got some inheritance dollars, or maybe I got a bonus at work this year. I got some extra money lying around, and I don't think there's any other better place to warehouse and keep my money than by storing it inside of a whole life policy with a mutually owned insurance company. So, Larry, how can I get this extra money funneled through this policy? And then that's when the conversation of the MEC comes up. And I just wanted to give, especially for my analytical folks, I want to give y'all more context when we're talking about the modified endowment contract. So that's why I'm very excited for this episode, because actually I'm here today with Mr. Clay Summers, and I call Clay Mr. One America. So he's been with the company American United Life, or also known as One America, up in Indianapolis. He's been with the company going on 40 plus years. So Clay, I know you're a hot shot over there, so I just appreciate you spending some time with me on today's episode.
It's my pleasure to be here with you, Hannah.
Thanks, man. So I guess one thing, okay, let's kind of start here, especially when we're talking about utilizing a whole life policy, because that's all we want to do. If your intention is to become your own banker, we only really want to use a whole life policy. And I'm not going to get deep into that conversation on today's episode. Go back to my past episodes where I get deep into the different products. But when it comes to utilizing a whole life policy, there's something called the MEC. And I guess maybe, Clay, I'll ask you that as my first question. What even is the MEC? How would you answer that?
What a great question. To define MEC, you really have to kind of go back several decades, maybe before you were born, Hannah. What happened was in the 70s and really into the early 80s, they had developed a product called single premium whole life. And so a lot of people were dumping money into the policy, have a very large cash value, but a very teeny death benefit. The difference between the cash value and the total death benefit, very, very small. And so really what they were doing is taking advantage of the tax advantages of life insurance, but not really having a lot of life insurance, in the policy. And so it really started to look a lot like, maybe a savings account, instead of, or something along that line, maybe more like an annuity than a life insurance. And so that kind of prompted the government to pass a law that would kind of define life insurance, really is probably a good way to put it. And this law was the TAMRA, the Tax and Miscellaneous Revenue Act of, I think, 1988. And it applies to any policy that is issued on or after June 21st of 1988. And so the vast majority of policies today are subject to the regulation. And inside the regulation, it created a new status, a new type of contract called Modified Endowment Contract. And we colloquially call that a MEC, right? And sometimes we'll say that the policy MECs, or that policy is a MEC. And what we're talking about essentially is policy that fails the test that the regulations created, which is also called the 7-pay premium test. And so that's really how MEC came around, and that's what we have.
Yep. Hey, and before we get into 7-pay premium test, Clay, talk to us a little bit about what your day-to-day activities are like at the home office. What are you up to?
Well, you know what? I've done a lot of things at One America. I started out in personal production, but I'm currently in the home office, and I've done a wide variety of things at One America. I've a lot of management and distribution positions. And so today, my biggest goal is to drive life sales across the country from our two individual distribution channels. And so that's my responsibility. And the best part of it is I get to work with people just like you, Hannah.
I know you're too sweet. And for my folks too who are listening, y'all, if you guys are coming out to the October mastermind, the Money Multiplier mastermind event, October 10, 11, 12, Clay will be coming down, and I have Clay doing his really cool presentation and kind of keynote talk. So Clay, you're just very good with the audience. I'm excited to see you live and in action again.
I'm looking forward to that.
So then talk to us. Okay, so now we know what a MEC is, right? And how I describe it to my folks when they're asking me questions about it is that the MEC is just that underlying factor of what deems an insurance contract taxable or non-taxable. Now, if you go back even to Nelson Nash's teachings, he always talks about that, hey, even if your policy becomes a MEC, it's not the end of the world because you still have that control and the freedom of where you're warehousing the money and what you're able to do with your money inside of the whole life policy. But now that we have what the MEC really is, talk to us a little bit about how that MEC is found. What is that 7-pay premium test?
Well, let's back up just a tad because I do think it's a good idea to understand exactly how good or bad MEC status is. And MEC status is really all about the taxation of the policy. And so what I like to say is that there are two good things about a policy that becomes a MEC and three bad things, right? Or three things that maybe you don't prefer. And so the two good things, the two things that are retained if a policy becomes a MEC is that number one, the growth, the cash value growth in the policy over the years remains tax deferred. In other words, you're not going to get a 1099 every year as the policy gains, over time, right? As long as that money is not touched, you'll never see a 1099. So that piece is still sustained or retained in a policy. And the other good thing, and this is probably the best thing that life insurance really provides, is the death benefit. From a tax standpoint, the death benefit remains income tax-free to a named beneficiary. And so really, to me, the most important thing about a life insurance policy is the death benefit that it creates. And then so from a MEC status, if the policy is a MEC, that death benefit is still going to be paid income tax-free. So those are the two really good things, and those are great things. The three challenging things that MEC status changes is number one, if a policy is not a MEC, it has what we call FIFO tax treatment, which is first in, first out. And what that really means is that if you distribute money from the contract, that you can actually take principal out first and then gain out after all the principal is taken. And so if you can think about that, that gives you a tremendous tax advantages. Well, if the policy becomes a MEC, that FIFO status is removed and it becomes LIFO, L-I-F-O, which is last in, first out treatment, which means if there's any gain in the contract and you distribute money, the gain has to come out first and then you can take out principal. And so you can imagine that's not nearly as good of a deal as FIFO would be. The second thing that MEC status changes on a policy is that the distribution, a policy loan is treated as a distribution from a tax standpoint. So normally if you borrow money from a policy, that's not a distribution of any type of, policy cash value. But if the policy is a MEC from a tax standpoint only, then the government deems that if there's any gain in the contract, then that's going to be considered a distribution, which means it would be taxable. So even though you're just borrowing the money, if there's gain in the contract, you're going to get a 1099 for any gain, up to the, what you borrowed up to the gain in the contract. And of course, that's not nearly as good of a deal as, if that weren't in place. Yep. And then the third thing that's, bad about a policy is if you are under age 59 and a half. And you take any type of distribution from the contract. And remember, we just defined a distribution to be either a withdrawal or what we call a partial surrender of paid up addition or a loan. Those are considered distributions from a tax standpoint. So if you take those distributions then, and you're under 59 and a half, there's a 10% penalty, tax penalty on the gain, that you've distributed. And
Yeah.
so obviously those are all three difficult things. Those are things that you would not want, right? And so I think for most people, if they can, they would certainly choose to avoid MEC status if they can. Does that make sense? And did I, hopefully I've made myself clear on that.
No, and you did. Well, and actually, One America does a very good job notifying their customer policy owner if a policy does become a MEC, because honestly, I don't even think the home office wants their contracts to be a MEC. And even one time, I've shared this before on the podcast, where Pops even tried to purposely MEC his policy just to see what would happen. So then you would have that knowledge base. If somebody does MEC the policy, hey, this is what would happen. And so One America, actually, y'all send a letter out in the mail saying, hey, just FYI, your policy is now a modified endowment contract. Are you sure you really want this? If you do, okay, sign your name here, send us back this letter. But if not, we're going to return you the premiums that the policy cannot hold to remedy the MEC status. And so I just like that a lot, because some people do have that fear that, hey, well, what if I accidentally do this? Well, it's okay, because the home office is there to also support you and protect you too. I don't know, is that a fair statement to say?
I think it is. And, I can't speak to what other companies do. The only remedy to, keep a policy from becoming a MEC would be to refund the premium that's going to cause it, or at least the extra premium perhaps that would cause the MEC. And so One America does do that. They try to be a watchdog for that, and give clients the opportunity to back that premium out before it's applied to the contract, causing the policy to become a MEC. And so I'm pleased that we're able to do that. And it sounds like you've experienced that is exactly what we do, which is good.
Yep. Now then take us through. So what is the 7-pay premium test?
Okay, so first of all, just so that you know, I think that the law, and I'm not a MEC expert, about the only people who are really MEC experts would be actuaries who price life insurance products, who have also deeply studied the laws and the regulations behind MEC status. But I know enough to be dangerous, so I can give you my opinion on what's going on. And so from that standpoint, when a policy is created, there's something called the 7-pay premium test. And really what this says, what this is in a nutshell, is the company calculates what 7-level premiums it would take to pay the policy up forever. In other words, if I paid these 7 premiums for 7 years, at the end of, as soon as that 7th premium is collected, then the policy would be paid up. And so whatever amount that is, that becomes the 7-pay premium. And so at any point in time, once a policy is issued, the premiums that are actually collected the total premiums you paid to that point can't ever exceed the total 7-pay premiums that are added up to that point. And so if you do exceed it, then the policy becomes a MEC. And I do think it's important to also mention that each company interprets the law on their own. And so I do think it's possible that there could be, slight differences of interpretation from company to company. And remember, each policy is different, right? So what it would take to pay up each policy might be different, especially from company to company, and even really from a different policy created by the same company. And so, it's just not so many times people want to make this a very simple calculation.
And a very
honestly,
linear one too.
It's just not simple.
Yeah.
But you can rely on whatever the company says, then you can rely on that, that being the 7-pay test.
Okay.
So that's at issue, right? And so down the road though, generally if you're not overfunding the contract, and again, we're talking about whole life here, right? If you're not overfunding, and when I say overfunding, what I generally mean is that you're paying out-of-pocket premiums and directly purchasing paid-up additions. So we would call that, you would have to generally add a what we call a paid-up addition rider to the contract, and then you're buying those paid-up additions with PUA rider premiums, right? And so if you're going to continue to pay PUA rider premiums, then you need to be thinking about what would happen in the future.
Yeah.
because without PUA rider premiums, you probably don't need to worry too much about MEC status unless at issue you were warned that so at some point down the road the policy could become a MEC with no other changes. But let's focus our attention on PUA rider premiums, because I know that you guys really promote PUA rider premiums, and I would imagine a lot of your clients are doing that.
Mm-hmm.
So here's the thing. The MEC rules state that every time the policy is materially changed, then a new 7-pay premium must be recalculated or must be calculated. And so what is a material change? A material change essentially is anytime you increase the death benefit of the policy. And guess what? Every time you buy a PUA with
Yep.
out-of-pocket premium, and that's really important as opposed to a dividend purchase PUA, but with an out-of-pocket premium, you're purchasing a PUA, you're actually increasing the death benefit. So the law states that every time then that a PUA is purchased, essentially, in general, then a new 7-pay premium must be calculated. And so think about this, Hannah. If you're paying PUAs in monthly, we're recalculating that 7-pay premium every month,
Yep.
which is just crazy. And it basically goes back to the last time there was a material change. So you do have to think about that. And so let's talk a little bit about the 7-pay as it's recalculated, because there's a new kind of a piece that kind of appears, that rears its head, if you will. And that is something called a cash value adjustment. So every time we recalculate a 7-pay premium on an in-force policy, we're obviously looking at an increased death benefit. So you'd think, oh, that's going to increase then the amount of premiums that you could pay. And that's generally true. But here's the downside. There's also a cash value adjustment that is made. And so we're going to use that, whatever cash value the policy is increased to, that's going to actually decrease the 7-pay premium. And if you think about it, this makes sense, because remember I talked about what happened in 1988. They're trying to keep the policy from being like an annuity or like almost like a savings account. They don't want it to just be, a savings. They or something that's cash value only. It needs to have a certain amount of death benefit to be truly qualified as life insurance, if you will, at least from a tax standpoint. So they're going to monitor that. And so that cash value adjustment, if you can imagine, in the early years isn't a big deal because the cash value is not so large. But down the road, as that cash value increases, that becomes even more and more effectual on the 7-pay premium. So what we see is early on in a policy, in life of a contract, in the early years, every time you make a PUA rider premium, that 7-pay usually goes up, which means it creates more capacity to pay premiums. But then as the policy ages, as cash value increases, you see those 7-pay premiums actually start to come down. And so sometimes I'll see producers recommend to clients that maybe they buy a policy and overfund it for a while, and then maybe buy a new policy. And my guess is that may have something to do with that recommendation because of the way that new 7-pay premium is calculated in the future.
Yeah, yeah. And I love how you just said that. So the 7-pay premium is not just for the first 7 years. That's a continuation of calculation year after year as that policy gets aged and matured until, hey, the end of the contract when we reach age 121. Is that right?
Yeah. Well, every time there's a material change, then we would we'd calculate a new 7-pay premium for the next 7 years.
Yep.
And so if you're continually making PUA rider premium payments, we're continually, recalculating or calculating a new 7-pay premium.
Yes, yes, because all my folks are, because especially if the policy's built for the intention of the infinite banking concept, paid up editions, we love paid up edition premium over here. Now, so that's good. Then let me tell you about this. Actually, this was a phone call I literally just had this morning with a gentleman. He was talking to me about his old IUL that he's thinking he wants to do something with, and he does have a policy that he just established with One America earlier this year, like back in February or so. And he says, hey, I want to, he came to me, he says, hey, I got about $20,000 here. I know I'm paying monthly premium right now. I think I want to pay up my premium for the year. And if I can, I want to even put more inside of this policy if it will hold it underneath the MEC limit. So, and I'm going to put myself on blast because Clay, I want to ask you this question. This is what I told him. I said, okay, we're going to call him Willie. I'm just making up names right now. So we're going to call him Willie. And I said, okay, Willie, well, let's do this first. Let's pay up the premium for the year, and then let's do a calculation for where that MEC limit is at. Because number one, just like how Clay was talking about with us, is that if we create that material change, that's going to have us calculate a new MEC limit or the 7-pay premium test. And then from there, then we'll figure out how much extra PUA premium we can pay without causing MEC status in the contract. So would you say that that's really the correct answer for how to work around that?
Well, certainly any type of caution before you make a change is great. And I would also encourage any type of a major change in a policy like that to maybe check, with the home office service area to make sure that if you make that change, that it wouldn't cause the policy to MEC.
Yes.
I've got a couple of things I'd like to mention on that particular, on the issue that you mentioned. Number one, premium mode changes. Believe it or not, premium mode changes can absolutely cause MEC status. Like most people, everybody knows that the way that most companies like to collect premiums are on an annual basis. But there are other ways to pay. You can pay on a less than an annual basis, right? And probably the next most popular route would be monthly. And so if you're paying monthly and you want to switch to annual, that can cause a MEC instantly. If you're paying annually and you switch to monthly, that can cause a MEC, although that's a little more rare. But especially when you're paying a small amount every month and you switch to a much larger amount, that can be trouble because the 7-pay that was calculated at the last material change will apply. And so if you're dumping in a small amount of, monthly premium, no big deal. But if all of a sudden then you want to pay a large chunk and it looks back at the last material change, it may cause a MEC. And so we see this a lot, especially when you go from monthly to annual. That can cause a MEC. And so I would, just before you make that change, I would just check to make sure that that's not trouble.
Yes.
So I said there were two things, though, that I wanted to mention. And this one, I think MEC and the way you calculate it and the whole idea behind it is rather complex. Honestly, it really is. And so let me throw another wrench in that makes it even more complicated. Sorry.
Yeah.
But this is important because there's one exception to everything that I've kind of talked about. Except for the 7-pay thing. And that is something, if you have a term rider attached to the policy, and with whole life, that would mean at issue, then you have one other thing that comes into play, and that's something called the necessary premium test. And it's only if you have a term rider on the contract. So if you don't have a term rider, you never have to worry about the necessary premium test. But if you do, you always have to worry about it. And so what the necessary premium test says is that at any point in time, the total cash value in the contract, if it is less than the single premium that it would take to pay the policy up, then any new premium that you pay will not excuse me, then at that point in time, if you pay a premium, it is deemed to be necessary, like a necessary premium to the contract, right? So if the total cash value is less than the single premium it would take to pay up the policy, then any new premium you pay would be necessary. So if it's a necessary premium, then we don't recalculate the 7-pay premium at that time. So only if it's past the single premium to pay the policy up would the 7-pay be recalculated. So for a lot of policies that start out with a term rider, if a new premium is paid, especially a PUA rider premium is paid, then that may not cause the 7-pay premium to be recalculated, which actually works probably not in your favor. And so what happens is we would see somebody, if they have a term rider and they pay up another premium, and they think, well, that's going to increase my death benefit. Why am I not getting a larger 7-pay? And so
Mhm.
this is what's going on. So this is the other reason, Hannah, and I know that you know this. Anytime you design a policy at issue and you know
Mhm.
you're going to have a term rider, then my guess is that you want to make sure you have enough term rider on that policy at issue. Because remember, you can't add term later in a whole life policy. So you want to have enough term on that policy at issue to create enough capacity to accommodate any PUA rider premiums that you think you may pay in the future. So if you
Yes.
think you may go up to this, or you may go down, you may go up, you want to make sure you have enough term at issue to accommodate all of that. Because when those premiums come in, there's a good chance that they're not going to recalculate the 7-pay. Does
Mhm.
that, and again, if I make myself clear on that, does that, did I explain that very well?
No, you did. You did. And a lot of my analytical folks are definitely going to like this because I mean, let's just be real. I mean, the reason that we're having this conversation today, and Clay, I wanted to bring you in is because on my YouTube channel, y'all have been asking me a lot of questions about MEC or Hannah, can you sit down with the banker and talk about the MEC and what happens here, here, and here in the 7702 and different things. And so that's why I wanted to bring you in. And this is the information I was looking for to give to the audience here. So the necessary premium test, which is just something that I did not know about when I got into this whole world. I mean, because even as time goes on, I still learn new things almost daily where folks are asking me questions. And I'm like, oh, shoot, I've never thought about that before. Let me go find us an answer. And that's what I really love about this community is that we're really just learning and evolving together. So no, that was good. Anything else that the people need to know about the necessary premium test?
Um, it just makes it complicated, and it
Yeah.
probably makes it difficult for people to conceive. In some respects, I think it's not even necessarily logical.
Yeah.
Same thing with premium mode changes. That doesn't make a lot of sense to me. But at the end of the day, it's the way the law is written. It's the way
Yeah.
a company interprets it, and so it's what we have. It's what we have to work with. And so the good news is that we're, like you say, One America always gives you a chance to back that premium out
Mhm.
to avoid MEC status if it would have caused MEC and you didn't want that.
Hey, and actually, where my brain's just going at right now, talk to us a little bit about the history of One America. One America's been around for a long, 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 long time. And actually, for my folks watching on YouTube, you can see in the back screen of the One America building right there in downtown Indy. So, how long has One America been around?
Well, so One America can trace its roots back to 1877. And so, since 1877, the companies have there was the original company and then another company that came together to form what was called American United Life Insurance Company, which is actually still the company, still absolutely an insurance company today. It's the company that we issue our traditional whole life products and term insurance through. So if you get a policy, it wouldn't say One America on it, would say American United Life Insurance Company, because that's the company that manufactures those products. But then I think somewhere in the early 2000s, I can't remember the exact date, American United Life Insurance Company formed a mutual holding company, and a mutual holding company that would allow our organization to bring together other insurance companies, other mutual insurance companies under one umbrella. And so that umbrella, from a marketing standpoint, is known as One America. And so you can see that's so most people would know us today as One America, but it actually One America is composed of several insurance companies and a few other operations. Chiefly American United Life Insurance Company, State Life Insurance Company, and Pioneer Mutual Life Insurance Company, and like I said, a few other things that maybe would be less known. But that's where we are today, and we are based out of Indianapolis, Indiana. And you can see we're recording this podcast in the month of May. We have a great event in May in Indianapolis every year, and that is the Indy 500 race, which
Yeah.
is the greatest spectacle in racing.
Yeah, yeah. Dad went there last year. Actually, as I'm recording this in Daytona Beach, Florida, I look right out my window and I can see the Daytona International Speedway just right over there. So I'm with you. Never gone though. I don't know. Because, okay, so mom and dad went and they said they had a great time, but mom says, yeah, I did it one time, but I don't know. It's just not my cup of tea. Just watch them go around and around and around. I was like, okay, mom, but I gotta just go and try it one time though.
Well, there you go, right? So,
Well,
and Daytona is a great place. That we call that stock car racing, or at least that's what we call it back in the day. And Indy is open wheel racing, so a little bit different style, both fun. And of course, we love the Indy 500 here in Indianapolis.
yeah, yeah. Now, hey, I guess real quick too, before I leave this topic, what about dividends, right? One America's been paying dividends for a long time. I think Mr. Allen told me up to date it's about 147 consecutive years. It could be a few numbers off.
Right. We're not aware of any year that One America did not pay a dividend, and so we continue that to this day. We've been fortunate to pay dividends every year, and the only people who own our organization are our policyholders. And
Yep.
so whenever the company then makes a profit, we return those profits in the form of a dividend, or at least um, to our policyholders, and to our policyholders that have what we call a participating policy. In other words, a policy that would participate in the profits of the company. And traditional whole life insurance, absolutely a participating policy at One America.
Yeah, yeah. And you guys just have very strong values of, never demutualizing, which I just think is very important, especially when you're looking at who to go and purchase a whole life policy from, especially if it's going to be for IBC. I just think it needs to be with a mutually owned insurance company. So that's one of my favorite things about y'all.
Well, I
Um,
should clarify though that each company underneath the umbrella did switch from a mutual to a stock company so that the umbrella could own all of the companies at once. But the umbrella organization is a mutual organization because we are not owned by any other entity than our policyholders. So that's probably a better way to put it.
Good, good. Hey, now what about RPU contracts and how does that affect with the MEC limit? And just real quick, RPU reduced paid up. Sometimes I'll talk about RPUing policies from time to time. I'm just going to tell my personal opinion. I am never, hopefully, ever going to RPU a policy contract just because I see the benefits of always paying out of pocket premium to my policies, especially when I get into those later years and the growth and the compounding that's happening within inside of it, and thus always increasing my cash availability. My death benefit keeps rising year after year. But some people will ask me, hey, well, can I ever stop paying my premiums? Or what happens if I do need to RPU this contract? So I guess how does that RPU play when it comes to our MEC limits?
Well, so you just really need to be careful for a lot of reasons. First of all, I agree with you, and this is my personal opinion. I am not a fan of taking a policy to reduce paid up. I just really think that there's a lot of great reasons to continue a policy as it was issued, and there are some ways that you can pay less premium in some instances down the road without having to take the policy to reduce paid up. Reduced paid up is a irrevocable decision, and so you can't make changes in the future. The other thing is you would want to take a very close look at what other effect there are on the policy with reduced paid up. For instance, you lose riders when you take a policy to a reduced paid up, and that's losing a lot of benefit that was created in the contract. So, but
Mhm.
today's discussion is on MEC status. And so that's the other thing that you need to be very careful about. Taking a policy to reduce paid up, or really anytime you decrease the face amount of a policy. For instance, if you had a term rider and you terminate that term rider, that would decrease the face amount. Certainly reduce paid up reduces that death benefit as well. Anytime you do that, there are circumstances when we would look back at the last material change that was made and apply that, we would recalculate that 7-pay premium based on the new face amount and bring that forward. We look back retroactively at the premiums that have been paid since that material change. And so that could cause a MEC immediately. So you just, again, if you were thinking about reduced paid up, number one, maybe rethink it. Number two, certainly have our policy service department let you know if making that change would cause the policy to be a MEC, and that would be a great idea.
Okay, I'm good. At the end of the day, we're just always calling you because I don't want to lead somebody down that path. I always just think, hey, well, let's ask the home office. Let's go ask mom and dad. Can we do this? Yes or no, mom and dad? And they'll come back to us with that answer. Just always go check with mom and dad is my message to you folks. All right, man. Well, I appreciate you. Are there any other topics that you think the listeners should hear specifically around the MEC limit and different things that they should be aware of or that they can start implementing as they use their policies?
No, I just would think that, I would congratulate anybody on their decision to purchase a, whole life policy. It's a great contract to have. Obviously, the most important thing is death benefit in my mind, and the legacy that you create, the immediate estate that it creates. Especially in a family situation where you would leave that to your heirs. Of course, there are many business reasons to own it as well, but certainly it comes with some tax advantages, which is can be very helpful to some people. So it's a great financial instrument to own, and just congratulations on your decision to purchase a whole life insurance.
Yeah. Hey, Clayton, you actually made me think of something. One of the topics I'm going to be talking about at the upcoming mastermind is, because we post a lot of content and webinars and live speaking about the infinite banking concept. How can I use the cash values to finance the things that I'm already buying in life right now? But, there's other things that folks are coming to us and we're helping them with. Maybe right now they're not ready for a whole life policy because of budgeting reasons. So maybe a convertible term makes more sense for that individual, because I do agree with you. Death benefit's very important. I know sometimes we don't talk about it a whole lot, and that in some of the webinars, it's not our main focus, but I think I know it's the only insurance in the world that's actually guaranteed to happen. So, convertible term, we do a lot of, or even like in the business world, buy sell agreements or key man employee policies and different things. So for y'all coming out to the October mastermind, I'm going to be getting in deeper to other vehicles. And oh my gosh, I just even forgot too, asset-based long-term care. I made my mama go out and get one of those. Dad, we're working on him right now because I see all the crap and the BS that they have going on with my mom's mom and dad, who I like to call Nanny and Papa, just with, Nanny having dementia and different things too. I said, y'all ain't going to make me go through all that BS. So just a whole bunch of other stuff, just not whole life, that we are always talking about and educating over here too. So I'm happy to have the support, and One America Home Office is going to be out there at the event just to chime in and talk a little bit more about these different products and vehicles that are out there. So, Clay, I appreciate you.
Well, thank you so much. It's been a pleasure to be on your podcast, and I wish you and all of the people who listen to this the best in the future.
Absolutely. All right, I'll catch everybody here soon. I'll see you next week. Bye, everybody.